Markets in the last few weeks have actually been quite awful. We have seen a correction in equity markets, which was close to 10%. So that's not only in Europe, that was worldwide. And the triggers for that were actually bad economic news. We saw a sell-off based on the IMF's global concern for economic growth. They shaved it off and limited it to 3.3%. We saw weak German manufacturing data. Now, this is very important, especially for Europe, as Germany is an economic powerhouse in Europe. So if Germany has a recession, then definitely Europe will have a recession. And last but not least, we saw also the tumble of oil prices. So oil prices is an omen for manufacturing. And if oil is falling, investors do take this as an interpretation that global industrial production comes down. There's a lot more happening in people's mind. It's not just about the economic data which we have seen. Fear is around us. We have seen terrible pictures by ISIS, but we have seen also terrible pictures on Ebola. Ebola, which killed a lot of people in Western Africa, and which seems to spread now also in Western economies. But it's not yet the virus which is spreading. It's the fear which is spreading. And when we look and we compare the Ebola word count with the fear index of Wall Street, the VIX index, it's actually amazing to realize that the correlation between the Ebola word count provided by Bloomberg and Google is extremely high. We speak about a correlation of 0.85%. This cocktail of fear and bad economic data makes investors very edgy. The visibility is very low. And what many investors have chosen is to vote with their feet. They sold risk assets, such as equities, and put the cash on the side. Their scenario is probably a quite bearish scenario. And the bearish scenario is that we will see a triple dip recession in Europe, especially as German data was very weak. But also banks in Europe are very weak. We cannot afford another shock in Europe. Last but not least, oil comes down. That means manufacturing comes down. So this cocktail of facts and fear have made that investors sit on the sidelines at this stage. There's definitely another side to this coin. One can have a positive view. And why would one do so? First, the euro has depreciated by over 11% since its peak. That means very clearly that European companies nowadays are much more competitive, especially in the international environment. Second, the austerity which has been demanded by the German government is much less rigid. The German economy is not anymore as well placed as it was even 6 months ago. We see the ECB pumping a lot of money into the European economy, which is very important, especially for risk assets. We see definitely also that the oil price, which has come down, is a trigger for consumer spending. Consumer which spent less money on oil will spend it on other items. And last but not least, we believe the Ebola virus will not be very contagious in the Western economies. Why do I say that? I'm really believing that the CEOs of major pharmas, which came out over the last week and presented and promised that up to 500,000 vaccines would be available at the end of this year, that they will stick to their word. We try to face the fear with a lot of discipline and rationality. We believe that's the only approach to capital markets. So although at this stage we are very much on the same side than many of our fellow competitors, investors are not necessarily on that side. In order to make a return, we recommend to our client to use this fear which is in this market to open new positions, especially in risk assets, and to stick to it for at least 12 to 24 months.